Well, guys, it finally happened. The 10-year and the 2-year briefly inverted. This is the bond yield inversion that we've been talking about. However, I'm here to give you some good news, at least in the midterm. We're going to go over some data as to why the market can and most likely will get back to all-time highs and maybe even make new highs before a recession or anything of the sort even happens. And you definitely want to stick around because you don't want to miss the best days in the market. The stock market tends to perform really well right after an inversion. How well, you ask? Well, let us get right into it. Why don't we? If we look at the last 4 recessions and yield curve inversions, 1988, 1998, 2005, and 2019. Those are when the inversions happened. Obviously, the recessions didn't happen until later. There was the 1990 recession, the 2000 dot-com bubble, which was a recession, 2008 recession, and the 2020 Rona crash recession. Look at the stellar returns of the S&P 500 after the 10-year and the 2-year bonds invert. Remember what I've been telling you all along. Since 1955, equities have peaked 6 times after the start of an inversion. So we usually get a market high, and the economy has fallen into a recession within 7 to 24 months. And it is even at the latter portion of this, closer to the latter portion of this in the last 4 recessions. So the stock market return after the inversion of 1988 was 33%, 1998, 39%, 2005, 24%, and 2019, 18%. That is from the start of the inversion until the bull market peak before the recession actually happened. And here are the months that it actually took for the bull market to peak. So 19, 22, 21, and then we had a very short period in 2019 and 2020 at 5.8. Who knows if this would have been longer if the pandemic didn't happen? I'm not here to argue that. I don't think anyone can say. Either way, you could tell that there is a very long time usually between the inversion and the start of a recession. And as you can see now, the markets are flying, and that is why I've been saying all along that I expect a market top before I expect a market bottom, meaning that I expect the markets to at least get back to all-time highs before we see some sort of major crash below the levels that we already achieved, or even worse, a recession. Especially when the yield curve is on the verge of inverting, that means bonds are not doing very well. And since bonds are competing with stocks, if folks aren't pouring their money in bonds, then they're likely putting their money in either real estate and or stocks. However, the real estate market right now is also effed. So there is no alternative, and that's why you're seeing a lot of this money pour into stocks. Usually the yield curve inverts after there has been tremendous economic growth, and we are seeing inflation levels getting to ridiculous heights. And that is why the signal is in the bond market, because investors are not willing to buy the shorter term bonds out of fear of inflation. That is why the yield curve inverts. I've talked about this ad nauseum if you're a fan of this channel, but very, very, very short summary. Investors are not buying the short term bonds, i.e. the 2-year bonds. And so the more that you don't buy those bonds, the rates go up to attract investors. However, they are pouring into the 10-year bonds because they want to protect their money for longer, because of the fact that inflation is rampant, right? So they are buying up the 10-year bonds, driving the yields of the 10-year down, and the yields of the 2-year, because nobody's buying them, are going up. And then after a certain point, the yield curve inverts, meaning the 2-year actually pays you more than the 10-year. And this happened for a very, very brief moment on March 29th. Another reason why I think we're going back to all-time highs and potentially making even new highs is because the jobs market is not signaling a recession either. Cyclical jobs growth is still stellar. Cyclical jobs is defined as construction plus manufacturing jobs. And right now we are on an uptrend. And if you look at the last few recessions, these are the last 12 recessions, you will see that cyclical job growth has actually been declining. However, we are not at that level yet. It will take a while for that to happen. And finally, this is something that I even didn't know, and I really wasn't paying attention to, if I'm being honest, is that not only is the 10-year and 2-year inversion important, however, a recession hasn't happened, at least the last 4 recessions have not happened without the 10-year and the 3-month inverting as well. And right now we couldn't be further from that. This is actually widening. The difference between the 10-year and the 3-year, or sorry, the 10-year and the 3-month bonds are actually rising and not falling towards inversion. However, if you look at 2006, 2007, we inverted. The year 2000, we inverted. And the year 1989, we inverted just before the 1990 recession. So, and then obviously right before the Rona crash of 2020. So we couldn't be further away from it now. So we don't have the 10-year and 3-month threat that we usually have when the 10-year and 2-year starts to invert as well. It could be a while before this happens. I don't know if it might happen when the Fed starts selling treasuries towards the end of the year. Who knows? This is why we continue to buy stocks. Now, I'll admit I didn't deploy every single piece of cash that I had on the sidelines, but this is why we dollar cost average into some value stocks as well as some mega cap stocks and the indices as well. On the option side, we've obviously been doing the day trades every single day because you wake up neutral. We closed a call on NEO for 60% today, on Micron for 115%. This is what the day trades look like. We've also been playing some earnings, although admittedly not as much as we were doing before. However, there are select earnings plays that we still played. Yesterday, we played a put spread on Lulu. We also played a Micron call, and we continue to maintain our hedges like we've been doing since November, although currently our hedges are now finally down as the market is ripping. However, our stock positions are disproportionately sized to the hedges, or else they wouldn't be hedges. If you want access to all of this stuff, including all of the bots, the options trade bots, the dark pool orders, the scalps bot, etc., link is in the description below. Come join our boisterous group. Would love to have you. And lastly, I will leave you with this. The S&P 500 hit its ultimate peak and average of 17.1 months after the inversion, while a recession started on average 21 months later. This is going back to the last 4 recessions. Here's the most important part, that investors who sold when the yield curve first inverted in December 14th, 1988, missed a 34% gain in the S&P 500. Those who sold on May 26, 1998, missed a 39% in the S&P 500. When the yield curve inverts, the median return in the S&P 500 is 19%. Do not miss the best days in the market out of fear. Apple was down almost 20% from highs. Folks are so happy to buy it when it hits $3 trillion market cap once again at $180, but nobody wants to buy it when it's down almost 20%. The NASDAQ was down almost 20%. Tesla was down over 43% from highs. The point is, it does not matter what you think is going to happen. If you see companies and indices that you think are priced cheaply in accordance or in relation, to where they were before, you go ahead and you buy that if you are trying to make money buying stocks or accumulating stocks. When else are you going to buy? When there's a confirmed all-time high? Anyway, traders, it is your money and your decisions. Do what thou wilt. I'm just here to provide you with the best information that I can, and hopefully you take something away from that. If you get anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think of this data. If you have any questions, let me know. I like to answer everybody. I try to answer everybody. So leave it down there. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.